couple of days ago, someone left this comment for me, and that's what we are gonna do. Research these companies and see if they pass our filters. 10 companies from 5 different sectors. We will create a series and do them one by one. We will start with Palo Alto Networks, and I will add the links to the next companies in the description when that's ready. So make sure to like the video and subscribe to my channel not to miss your favorite company. We have a lot to cover, so without further ado, let's get it started. Palo Alto Networks provides cybersecurity solutions worldwide, selling firewall software and cloud security, based in the US and founded in 2005. They have been growing their revenue very fast from 250 million to 6.5 billion in just 10 years. If you use the 72% rule, they have grown their revenue 26 times in 10 years. 26 times is 4.5 doubles. So a double every 2.2 years. 72 divided by 2.2 is something like 30%, which is very fast. If you want to know more about 72% rule, check this video. Their fastest growing part is their subscription revenue, which is very good since that's a recurring revenue and it creates loyal customers. Most of their business is in United States, so they have a lot of potential to grow in other areas. As a point of reference, Cisco, which is one of their biggest competitors, have a 55 billion revenue, so they easily have the potential to grow 10 times in size. Next, we will take a look at their earning and free cash flow. They have had a negative earning for many years and just recently became profitable. That's a bad sign for us. We want the company to be profitable for at least 5 to 10 years before we even consider investing in them. We don't want to gamble on them making money later on. We will only bet on sure things. But their free cash flow has been always positive, which is a good sign. We care about cash flow more since it's a better indicator of profitability than earning. Free cash flow is calculated by deducting capital expenditures from cash flow from operating. And it's important because that's the amount that belongs to us shareholders. According to accounting rules, cash flow from operating contains stock-based compensations. So we need to check and see if that's the reason why their free cash flow is so much higher than their earning. For that, we look at their latest annual report on their website, and we can see from 2020 to 2022, their cash flow from operating activities was 1 to 2 billion. And their capex was around 200 million, which makes their free cash flow 0.8 to 1.8 billion. But 0.6 to 1 billion of that was stock-based compensations, which really does not belong to the shareholders and should be considered a financing activity and not an operating activity, since that's how they finance their employees' pay. But that's how the rules are right now, so we will deduct that from the free cash flow and reach a 200 to 800 million of real free cash flow, which is closer to their earning, and their statement is making more sense now. And if you are wondering about the tool I'm using, this is simply Wall Street. It's a great product with access to more than 50,000 companies in 90 countries all over the world. You can check financial info, news, valuation, dividend, shareholder structure, and much more. I have their unlimited account, which costs $20 per month. But if you use the link in the description below, you can get 40% off with a 14-day free trial period, which makes it a no-brainer. So make sure to test it out. Thank you, Simply Wall Street, for their great offer. Now let's continue and look at their revenue and expenses breakdown. We can see most of their revenue is being spent on marketing, so that's how they keep their growth, which is good since they can reduce that if needed, but probably will affect their growth. After that, their biggest spending is on R&D, which can be reduced too if needed, but cost of sale is probably not reducible. They have a 70% gross margin already, so they are working pretty efficiently anyways. But they are a software company and that's expected. Let's look at their balance sheet now. They have 4 billion of debt compared to 1 billion of equity, which is too high, and with negative earning and 1 billion of free cash flow, it's not easily payable. The good news is they have 4 billion in cash too. The other issue is their short-term long-term assets have been lower than their short-term liabilities for the past 2 years, which is dangerous. We want a current ratio of over 1.5, and they have 0.7 right now. If we look at their shareholders' equity, we can see that they have a negative retained earning and positive paid-in capital account. So probably they have been diluting their shareholders, which we can see here is the case, from 200 to 300 million shares out, while spending $1 billion a year on share buybacks, which is sometimes a tactic that management use to pump up their share price and make themselves rich, since they're getting more share options, and even sometimes the amount of options they get is tied to the stock price performance. Share buyback only makes sense if the price is lower than the intrinsic value, which 1 billion of real free cash flow, 6 billion of revenue is not a good look for 77 billion of market cap. So the stock seems overvalued, but management is buying back shares anyways, which tells me everything I need to know. This stock is not a buy right now or maybe ever, but since they are growing pretty fast, we will keep them in our watch list to check on them later on and see if all the earning and free cash flow growth already priced in the stock would materials or not. Either way, let's do a valuation on them. You know I don't like to use pen and paper on my calculation. I believe if you can't do the calculation in your head and it's making sense and hitting you in the face that this is a fairly or undervalued business, then you should not buy the stock. Let's say they will grow their revenue 20-something% for the next 10 years. We will use the 72% rule again. 72 divided by 24 will be 3. So every 3 years, they can double their revenue. So in 10 years, they can double their revenue a little bit more than 3 times, which will be 10 times. So their revenue would be 60 billion, which is what Cisco is making right now. So it makes sense. And let's say they can achieve a 25% margin on their free cash flow, which is typical for their industry. That's make it a 15 billion in free cash flow. Let's again imagine they will be selling for 20 times their free cash flow. So their valuation 10 years from now, if all our assumptions come true, would be 300 billion. We know we want to make 15% per year, so we again use 72% rule and divide 72 by 15, which will give us 5. So we need to double our money every 5 years to be able to make 15%. In 10 years, we need to quadruple our money. Divide 300 by 4, which makes it 75 billion. That's their today's value if all our assumptions come true and we wanted to make 15%. Right now, its valuation is 77 billion, which means it's already priced for perfection. And we know perfect things never happen. So we will just add it to our watch list, wait for it to see if we can buy it for a better price, and then continue our research. Thank you for watching this episode. Please make sure to like the video for the YouTube algorithm. Subscribe to the channel if you have not done so already. Check out Simply Wall Street offer, linked in the description. And next, watch this playlist with more company research. Have a great rest of the day and see you on the next one.